Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Wednesday, December 15th, 2021. So we have the big FOMC meeting out of the way. Today we had initial, very small and brief little dip down and then a pretty good sized rally. And as I've always said, I've been doing this for many, many years, and there are Fed meetings that you know will be, they are what they actually call lame duck meetings where nothing's going to happen. Then there's other regular meetings, but the market already knows because the Fed has telegraphed well in advance or based on economic conditions that there will, there'll be no surprises. So today was a big one. And what we had is a big meeting, that is. And we had a nice pop in the indexes. QQQ was the strongest. This makes sense. It's tech heavy. We rallied about almost 3.5%. At least that's into the close today, a little after our gains. 2% rally in SPY, but pretty much everything. What happened is Powell came out, and although they're going to increase the bond taper, he's still overdone it. The guy, honestly, I think he's if I had the ability, I'd fire him. I think he's horrible for what he's doing for the company. I watched a little of his press conference afterwards, and I wrote this down and put in quotations. He said, "I wouldn't look at it that we're behind the curve." And again, as you guys know, the headlines are all over the place, 40-year highs inflation with no signs of abating, and that's the thing. So, and I've said this for many years, the Fed has always, ever since I've been doing this, and before I did this, in technical analysis, my background was in business and financing. That's where my degree was, and started my career as a stockbroker. And the Fed has always been reactive, not proactive. So, in fact, in this case, he's should, even if he was being reactive now. In other words, he's completely missed the ball on inflation, but he's still somewhat in denial. But at least he's taken out the word transitory out of his verbiage, so that's one big plus. Anywho, listen. All right, so that's all here, neither here nor there. Big pops and some of the things we're looking at today, like silver up a nice 3.37%. From the lows. Gold rallied too, a little less. You're always going to get more bang for your buck in silver. I'm talking off today's lows, 1.5 in there. Platinum, etc. Nice move in platinum. That was highlighted too as a trade idea today, 3% up. And those alone offset any givebacks on the equity shorts, equity index shorts, particularly the Qs. Now we're going to walk this back in time frames here. So with all that being said, these big moves. And if you followed me for a while, you've heard me say this before. I put absolutely nothing, literally less than zero into, as far as a weighting goes, into this big move. Now a 3%, this is a 60-minute chart. You can see that big ramp in the SPY. And I talk about this a lot. There's big moves in the market. Number one, I dismiss any initial reaction on the big Fed days. Again, big Fed meeting days where there's a highly anticipated meeting, and that's what today was. So the initial reaction, I've seen it so often. It doesn't guarantee that the initial reaction can't stick. I'm talking about the rally we had today. I can just tell you over the years, I've seen the initial reaction quite often is not the lasting reaction. So it can be. Okay, so it's not just the fact it's a Fed day, but the other reason that I don't give any weighting to this reversal today is because technically it didn't change anything in the charts. And again, now, so fundamentally, yeah, I'll admit it. He surprised me even, and I think some as to how dovish he continues to be. He's certainly pivoted. Don't get me wrong. He's pivoted towards a more hawkish stance, but he's still, in my opinion, and I'm sure some others, certainly not tapping the brakes as aggressively as he needs to be right now with everything going on, creating these asset bubbles and whatnot. However, what happened today, this is SPY, and we're seeing, let me turn off the after hour trades because that's really, volume tapers off. Let me go to edit chart properties, not show those, and we'll just look at today's close. So the SPY parked right on resistance, and we're right back where we were all of last week. This is last week right here, right? We're up there. SPY, just like QQQ, has pretty big resistance up there, about 40.79. Why is that big resistance? Well, it's where it keeps failing. It had one failed attempt, a brief breakout on the 60-minute chart and just look at how many 60-minute candles ran up to or around that level. And so what I did for you is I color coded the lines that we've been trading, and the big ones that I've been highlighting lately, we've been range bound, and there's that big gap right there from last week. About 40.60 up to about 40.71 roughly. That's where SPY is. So we closed right up on resistance. And so although I threw out some objective short levels today, these are as well. Every resistance level overhead, when you have sell signals, until you start to, negate that bearish scenario. And again, I talked about this before. I would put almost equal odds, almost coin toss odds that the SPY might want to go up, pop that high, or at least equal that previous high to give us another divergent high. In other words, these indicators are lagging. So unless the SPY can really move up, probably 5-10% plus, it cannot, at least not anytime soon. Taking out the divergence is a function of two things. It's a function of the percentage that we move up, and how long we take to do so, because each day over time these indicators will change. So that's it. And more importantly, the index that I'm focused on the most, QQQ, let's see, I think I had I'm going to get to the daily chart and show you. That's where I banded with the blue lines, but I added one new trend line here today. This is only line that hasn't changed from the recent 60-minute chart I've been sharing on QQQ, because we parked at the close today. So technically I consider that a reaction. An ideal reaction is consolidation or a reversal off of level, but you also, when you close, that's that's the end of today's candle right there. So it's a potential level to watch. Now if it gets popped above tomorrow, it's obviously not really a very valid trend line, and there's not a lot of reactions. I like to see at minimum 3, and we have that there, 3 distinct reactions to validate a trend line, and so this could be a fourth, especially if we gap down tomorrow. And so you had this gap was backfilled, and again, let's jump out now to that longer term chart. But remember, 401 to me, it has been and still is the big level. And if and when that starts to go, certainly near term it's bullish, and it could have longer term bullish implications if we get anything more than a marginal new high, especially if the divergence is still intact. So we'll see what happens tomorrow. I'm leaning towards this. I think this is typical post FOMC noise, I call it. The initial reaction, positions getting scrambled, shorts covering positions, longs jumping in, and then it'll take about a day, either into tomorrow or early next week, for the market to fully digest everything that's going on, and then we'll have an idea where we're going. All right, so now we're going to go out to the daily chart. These are those levels, again, about 401, and the big level down here, 380, 280. These are the levels I've highlighted recently. Important because that was our previous all-time high in QQQ. We broke out right there, and then we came in, we back tested it once for a couple days there, and then we back tested it the last 2 days. You zoom in tight, these two candles today came right about down to that level again. And so again, this is why I can't put any significance on this candle. A, because it's a Fed day, and B, because it didn't do anything technical. If I see a big green candle break out above a resistance level, or a bullish chart pattern, or a bearish chart pattern, well, in the case of a bullish, green candle, a bullish chart pattern, that's good. That's what I want to see. I want to see a break above a trend line, and I like to see it. The greener, the better. More volume, the better. More chance that breakout will stick. This wasn't a breakout. This is just noise within a trading range, and it's just the bounce is accelerated. It's coming up a little faster than the last time we got there, again because of the FOMC meeting. So hopefully that makes sense for you, and we'll most certainly follow up on this tomorrow. Again, now we're on the daily time frame. We had negative divergence back here when we had this nice sell signal right here. Again, you had dual sell signals actually in recent weeks, but this one had the first divergent high on the daily chart since back here, and that led to this correction. And like all corrections, nothing goes straight down forever. You always have counter trend rallies. That was a simple ABC. This one's kind of a convoluted. We're moving sideways, and that's it. I'm not going to speak any more of it now. We'll have to see which way this range resolves. I still favor the downside. but you got to respect an upside break. Just because I think I can tell you we'll have that divergent high if it happens soon. Oh, we could keep going up. Remember, we've had two successful back tests of this level. And I've been saying this since the first back test. If you are bullish and you do believe this market has a lot more room to run, that was your best buying opportunity in months. It was since back here because that was a breakout. A back test of the breakout. So if you missed the breakout, you had 1-2 opportunities, and you could have set a stop a little bit below there. You could also take a breakout above 401 if you're bullish, and you want to see it ideally, on volume, and then you set a stop a little bit above there in case the breakout fails. It's that simple. And if you are looking for more downside and you don't have your fill of shorts yet, you're scaling in. You can either short a run up to 401 with a stop somewhat above, or wait for a break of 380, 280 and swing down to the next targets. All right, so that's QQQ, and now I'm going to jump all the way out to the monthly chart and just revisit something I've showed many times in the past. We're going to go back, we're going to roll back into the 90s, and this is simple stuff. We have the big drops over the years, and this is something I've highlighted, and this has, again, when we're going back decades here, each and every time, without any exceptions, so we're going to go to this point right here to where we'll start with the dot-com, when the dot-com bubble burst. Each and every single time that the PPO on the monthly time frame, the PPO made a bearish crossover, that's when these lines cross, and then that means the histogram goes red, has been associated with significant drops. A whopping 84% bear market that ended in late 2002. This one wasn't big, but it was associated with that drop there, which I measured out. I rounded all of these off, 18%. The Great Recession back there, 55% bear market. Again, this doesn't seem like much, and it wasn't much, but it was still a 16% drop, 13% drop. Again, I'm not skipping over any of these. 26% drop, 24% drop associated with that one, and I'm measuring highs to lows on each of these that came, and then a 31% drop the last time that we had a confirmed crossover. And look, I have to say this, these aren't timing indicators, because sometimes by the time you wait to get that monthly close, like that drop when COVID hit, the correction was over, so you really kind of missed it. But it shows market conditions. That's the takeaway I have from it, and it does actually, in many cases, in the big bear markets, it helps you confirm sell signals in the trend. Now we have again questionable sell signals on the weekly chart. I'm going to loop back to that because I skipped over that time frame. Here's what we need to see happen on QQQ. Number one, a break of the uptrend line that we have right now in the monthly, and that would be right there. Then we need to see, this is big support here, the 20-month EMA, so that would be our next support. We probably have a reaction around there, and then ultimately I think we'll still come back at some point and test the primary. This is the secular bull market uptrend line. A secular bull market, or cyclical actually, if you want to consider, which I really am, that drop in COVID, yeah, sure, it met the technical definition of a bear market because it dropped over 20% from the highs, but it's still, you can see, it's still, we're in a bull market. This is really the Fed. I call it Ursa interruptus, and that would be my term for a interrupted bear market. The Fed came in with the nuclear option. But again, look at the technicals. If you looked at this chart, and I didn't tell you it was a monthly time frame, and said, what kind of trend is this security in? I didn't tell you it was QQQ. You'd say, oh, that's a clear uptrend. There's your uptrend line, and there's your key moving average that's always acted as a great job of support. Bear market when you're below it. So we're above all that. Now, finally, and then I'll move on. I want to loop back to the weekly chart. You can see the histogram has never been this low. The histogram reading right now, and the month is young. We're smack in the middle. Today's the 15th. We just closed, so we're in the middle of the month, and the histogram's at a reading of 0.5, and it would be extremely unusual to see this come down here and not have a crossover in the next few months. Sometimes you get close. I'll show you. Well, no, I don't. Let's see. I don't even see an example. I know here it is. I knew there was one right there. You came close, And then the next month, the lines looked like they were ready to cross, but they didn't. They flattened out, went up, and you had a little upside that month. But again, that's where we peaked right here, and that was followed by that little delay. Whatever caused that, whether it was Fed action, whatever it was, looked like the lines were ready to cross, and they were. We just had one little blip up and then the crossover, and that was associated with a 26% drop, again, from the high to the low in QQQ. All right, so that's my point. Is once these hills, I call them, start rolling over, you can see the market's still going up. It's green. We're still rising, but the momentum is waning, and then ultimately they cross. It, again, not impossible to see these lines come very close and then this starts to happen, but it'd be very unusual. So again, that's everything's just waiting there. No sell signals on the monthly time frame. That's kind of 401k stuff. You keep long in your 401k until you start to see breakdowns and confirmed sell signals on the monthly chart. Weekly chart, remember, we had the bearish engulfings on both QQQ and SPY a few weeks ago right there. That was followed up by a check mark, because a bearish engulfing to me is only a potential topping stick. It engulfed those two, but you have to, at least I want to see, this is just my thing, you know, in textbooks it's going to say that's a topping stick, but I like to see at minimum one confirming red candle, and ideally more than that, and as I often say, the redder the better. So we had a red candle, certainly confirmed. This one I told you last week was not additional confirmation. It did not invalidate that, but it didn't give us that additional check mark. And this week, well, this week we're only halfway through the week, so let's see how this finishes. And if the Qs do this and they take out the top of that candle, well, I can tell you with absolute certainty it wasn't a topping candle. It's only logical. If that wasn't the top, how could it possibly be a topping candle? Here's a bearish engulfing. It proved to be a topping candle, and from that top of that candle to the till the correction was over 3 weeks later, there was a 14.3% drop. There's a bearish engulfing right there, and there was a drop of 12%. And they were really more correction candles. So, and that's all this one might prove to be, but it would be unusual based on all the sell signals that I've had, based on the 60-minute charts, that we only get a 7.29% drop. So that's it, guys. To be continued. We will not know anything about this or be able to make any concrete conclusions, and it might leave us hanging too. Who knows? Maybe we close the week here, we close it here. I'll still put another question mark. If we close above here, I'll say, well, you know, that at least this one particular thing, the bearish engulfing, didn't work out, but we'll still have some divergence on the 60-minute chart, and then we might get that new high scenario where we push up. SPY, same thing. SPY is still below the bottom of that last bearish engulfing, but pushing the upper limits of it. Little whipsaw here, and it's all about the fangs. I've told you that before. The market's not going anywhere without the fangs breaking down. So let's take it down now and look at the futures, and then we'll see if there's anything else I want to get in this video before we wrap up. Futures, that would be, let's start with the NASDAQ 100. Okay, again, big level. This is comparable to that 401 on QQQ at 16,424 right there. I mean, just look how many times we've had reactions there. They popped it, couldn't hold it. Once they broke back below there, rejected, 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 rejected. And these are numerous candles. I'm not looking at each and every one, just a cluster of them. Rejected, rejected, rejected. And so that's why this reversal today, based on the Fed, it didn't really change anything technically. We still have big support right here, about 15,536. If and when that goes, quite bearish, and that should open the door to my if things get ugly target. Breakout above there will probably propel us to new highs. I would say that is likely if we get a solid break over that 16,423 and 401 level on QQQ. But marginal, what would that mean? Let me try to drag it here. Well, this is what I'd have to shrink. It shoots over the top. That's about 3 point something percent. And you can see that would still have the potential. I mean, these indicators are lagging so much right now, the momentum indicators, that again, if we had a marginal new high within the next week or so, it's almost guaranteed to be a even bigger divergent high. And remember, these divergences come all the way back here. These divergence lines, they would continue like this. This one starts right here on the PPO, but the RSI back there. So Powell comes out wearing his dove suit again. And again, let me clarify. I know he's pivoted lately. He's pivoted a little, but he's pivoting way too slow, in my opinion, based on what's going on. And so, okay, but the fact that he was dovish, or at least didn't come out any more hawkish than was expected, you would think you'd see more upside in the dollar. Well, no, I'm sorry. If he would have been yeah, there it is. I'm stuttering all over myself here. He wasn't any more hawkish than expected. I would have to say probably right about where the street expected him to come in. And so for the dollar, it was a non-event. And where I'm going with this, I want to do an update on gold and silver. So we still have the dollar is still on that sell signal right there. Broke down from the bearish rising wedge. And you still have this line. I covered the dollar today. This is DX dollar futures. So that's it. And even if we're almost an equal high today, roughly. Just a hair below it. So for all intents and purpose, that's still an even larger divergent high, or it can pop up again, just like the markets. So if you are long gold, silver, platinum, palladium, any of the precious metals I mentioned earlier today, then that's what you need to see. That trend line there get taken out. Then my first target 95, 560, second target, and right now near term preferred target 94.59 plus the uptrend line should come in. So there's your setup and how the the dollar looks, and that's of course going to impact silver. If the dollar plays out that way, then you would expect silver to continue to rally here, come off this. It's got nice divergent low. You guys know me, I like to swing gold and silver, especially lately. These are tradable trends, and right now we're at not only divergence, because I always say positive divergence and oversold, those are not buy signals, not even close, they're conditions. But when you have positive divergence or a pullback to support with bullish divergence, that's an objective long entry. It's technically not even a buy signal, but it's an objective long entry. So buy signal could be a breakout above a falling wedge or any other horizontal resistance level, but it is objective. And again, nice reversal today. So let's see if we can get this upside. You can see the targets there, all potential targets. That's silver. Again, silver, you get a little more bang for your buck. And same with platinum when it's moving. Gold's a little more muted, just not as volatile as those two. But there it is, gold. Again, at that nice support level right there. I think it was here today, that 1764-ish. And then we had that knee-jerk reaction when the FOMC announcement came out, followed by a nice reversal there. And the bullish divergences are still very much intact right now. And then last but not least, I give you a platinum, palladium, same thing. Platinum, my pick of the two, because you have that scenario I laid out back here a couple weeks ago, that if we got to jog down to test that other low and extend the divergence, that would be a little bit better. And so, and you can also, that nice thing about buying a pullback to support is you can set your stop a little bit below. Don't put it too tight. This is the nature of the markets nowadays. Obvious support levels, pivot lows, reaction lows, things like that are quite often undershot. The algos clear them out. Market makers, whatever you want to, whatever you want to refer to them as, actually both of those will often clear those stops out and then turn around and go long themselves and run it up. So, anywho, that's your setup for or updates on the precious metals and the markets. The only other one I wanted to update, and I should have covered it earlier today, is Bitcoin. Remember, I've been watching Bitcoin. Calling this one like a champ for actually years now, and we had a nice setup. Let me go out here to the 2-hour chart. Yeah, that gives us goes back 6 months. Now here's a level that I said before, and I maintain, if we get there and the charts look constructive, which I think they will, that's, I think, a nice re-entry for Bitcoin. We had a sell signal back here, divergent high breakdown, and we fell. This is support right here, and that's about 44,920, and we reversed a little just shy of it today. We have a downtrend line right here that might come into play. We have divergence now, so this is why I wanted to do an update. That could be all it takes for a catalyst for another rally. Same targets I had on the downside now become targets on the upside. 53,593, 59,330. However, I think we'll probably get that one last thrust down. And if we do, and it happens soon, we should have positive divergence as well. So, one thing to do is what I started to do today, or scale. You can scale in, start buying it around here in case this divergent low plays out. Add to, but not down below 41,601. I'd be more concerned about stopping out or scaling out, just like I'm scaling in now, if it goes much below that. So there's your levels, and if it breaks out above the trend line, that should open the door for a run up there. The other one's Ethereum, ETHE. Let me cue this up. Ethereum, or no, I want ETH is what I wanted. The Ethereum itself. ETH. Nope. Okay. I had a glitch. I have to fix something on the charts. I have to download another thing. I don't have that chart right now. I had to download a stable version of that application that's not giving me the crypto symbols, but I can give it to you this way: ETHE and then ETCG, and show you that I mentioned this the other day. We had unconfirmed, and it is still unconfirmed positive divergence at support. So you have support on ETCG at about 1733 or so, and potential divergence. And so this one could run, or like Bitcoin, it may take another leg down. If it does, I'll certainly be talking about it right here. And if I forget to, remind me if it happens to fall down there. That's pretty even better support, or actually about as good. This is pretty decent support. We've had some reactions in there, but I see more reactions along this level. So there's your scenario. So I'm lukewarm on it. I think you could start a scale in here, down to but not below there. Look for a breakout above that, and we could run again in the cryptos. All right, let's keep this one short, wrap it up there. Again, let's not read too much into what happened today, but let's certainly note what happens going forward from here, because we have some pretty significant resistance just overhead on the indexes, as well as some very important support levels below. We're a lot closer to the resistance levels now. So I know it might sound counterintuitive, but I think it's still objective short. Anytime you get up that 401, you can short, keep your stops tight, or allow for a 3, 5, 6%. If you think we're going to go down and let's say test those 200 days, this is my longer term swing target, about 360. So well, that candle just quirked out. It's a drop of about 10% if we get there. Again, that candle was supposed to be up here. It was up here. I don't know what just happened, but let's end the video here. Turn that back on. Didn't make a difference. Okay. All right, guys, we'll wrap it up here. That's the incorrect data. Something just went wonky on these charts. There it goes. Came back. So, all right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.